banks were once ordinary institutions, places to store money and lend cautiously, but over decades they grew larger, more complex, and deeply intertwined with governments and the economy. The moment banks became too big to fail was not a single day. It was a process built on decades of borrowing, lending, and political influence. Pattern interrupt. Imagine a child building a skiing castle, believing the walls are strong, while the tide is already coming. In the early days, banks lent conservatively. Deposits were small, losses were manageable. But as economies expanded, banks discovered a powerful strategy. They could leverage deposits, borrow cheaply, and invest in riskier ventures. The bigger the bank, the more influence it had. Suddenly, entire governments depended on these banks to keep markets stable. Then crises revealed the truth. When one large bank faced collapse, the ripple effects threatened the entire economy. Governments were forced to intervene. Bailouts became policy, not exception. Fear spread. No major bank could fail without consequences for millions. Pattern interrupt. Think of a spider web, so connected that breaking one strand shakes the whole structure. The 2008 financial crisis made this clear. Banks had bundled bad loans into complex products. Even regulators did not fully understand the risk. When housing prices fell, the system nearly collapsed. Governments around the world injected trillions. To prevent catastrophe, taxpayers absorbed the risk, while many bank executives kept their bonuses. This moment cemented the idea: too big to fail. Size became safety. The bigger the bank, the more likely it would be rescued. This created moral hazard. Banks learned they could take massive risks because failure was no longer allowed. Ordinary people paid the price for decisions made in boardrooms. The wealthy and well-connected received new money first. The middle class and poor were last. Pattern interrupt. Imagine being told your house is safe, while the foundation beneath it is cracking. History shows this is not new, even in earlier centuries. Governments quietly rescued banks to prevent panic. But today, the lesson is critical. When banks become too big to fail, normal market rules disappear. Risk is shared by the public. Rewards stay private. Understanding this explains why financial crises repeat, why money flows the way it does, and why positioning matters more than ever. The powerful benefit first. Ordinary people manage the consequences. The system favors size, influence, and connections over caution. Pattern interrupt. It is like playing a game where only the strongest players can lose without consequences. The key takeaway is awareness. Knowing which institutions hold real power helps you protect wealth. Before crises arrive, this is Cashfree World, where we reveal the hidden rules of money, banking, and power. Subscribe to understand how the system really works and how to stay ahead of it.